Listen up, folks. Time could be running out to lock in a historic yield at public.com. But you can lock in a 6% or higher yield with a bond account. Here's the thing. The Federal Reserve just announced a big rate cut, and the plan is for more rate cuts this year and in 2025 as well. That's good news if you're looking to buy a home, but it might not be so good for the interest you earn on your cash. So, if you want to lock in a 6% or higher yield with a diversified portfolio of high yield and investment grade bonds, you might want to act fast. The good news, it only takes a couple of minutes to sign up at public.com. And once you lock in your yield, you can earn regular interest payments even as rates decline. Lock in a 6% or higher yield with a bond account at public.com/investing unscripted. But hurry, your yield is not locked in until you invest. Brought to you by Public Investing, member FINRA and SIPC. As of 9/26/24, the average annualized yield to worst across the bond account is greater than 6%. Yield to worst is not guaranteed. Not an investment recommendation. All investing involves risk. Visit public.com/disclosures/bond-account for more info.
Hey everybody, welcome back to Investing Unscripted, where we ask and answer the hard questions about investing. I'm Jason Hall, and coming in hot, the voice of the people, Jeff Santoro. Hey Jeff.
I don't know if I'm coming in hot. I'm coming in rushed.
Okay, fair enough. That's okay. But you know what?
I don't have any hot takes. I'm not angry about anything. I'm just rushed. Busy. I'm a busy guy.
Okay, it's okay to be busy. It's okay to be busy. We are excited about a mailbag episode.
Yeah, I gotta say, our loyal listeners and some new listeners who are also loyal, some of our regulars and some new folks sent us a lot of questions. In fact, we got so many questions and comments for this episode that we're actually going to take the last few that we received in the last couple of days and we're actually going to punt them until November because we had too many to answer in one episode. So this is the world we want to live in, Jason.
Yeah, that's exactly right. Our listeners are definitely answering the bell about sending us questions throughout the month. It's really useful and really helpful for us to be able to have plenty of things to talk about. So I'm excited, and I think we just have to get right to it because I really want to try to answer as many as we can. Any housekeeping you want to do before we get going?
No, I mean, if people keep sending us questions like they did this month, and they can be at any point, if you listen to any episode, you got a question or a comment. Some of the ones we're going to go over are actually more comments than questions, but I think they're going to spark some interesting conversation. So keep doing that. Check out the YouTube channel, sign up for the newsletter, give us ratings on the podcast apps. That's it.
I'm going to pitch this. I'm going to pitch the Savvy Trader real quick, Jeff. We don't talk about that a lot on here. It's doing well. We're beating the market in a bull market. I think I want to really highlight that. We're going to be picking our next stock that we're adding to the portfolio next week. So check it out. You find it on Savvy Trader. There'll be a link in the podcast description here. Find it on the transcripts. A lot of places you can find it, but check it out. I think there's some good stuff happening right there that you might want to actually give us money for. All right, first question.
All right. First question comes from Ryan on Twitter, and actually it's a comment, not a question. I've always liked the idea of having cash set aside as dry powder for market downturns, but so far I have not been disciplined enough to not spend it the second it hits my account. About 3 months ago, I decided it was time to stop being, I'll edit this for our family members, a moron that bought into companies based solely on borrowed conviction and actually did some research on my own using the ideas as a starting point. I will not allow myself to buy another stock until A, I've come up with a more formal process for evaluating companies before I buy, and B, actually follow through with the entire process without skipping steps due to FOMO. The result? I now have a 1.4% cash position, the largest I've ever had, and I still haven't finished with part A from above. However, I am researching ideas for my process, such as taking pieces from David Gardner's risk assessment and traits of a rule breaker and figuring out how to actually do a DCF, which is a discounted cash flow, because I'm a math spreadsheet nerd and it sounds exciting. I just want to stop right there and just give a shout out to my spreadsheet friends.
Yeah.
I'm not a math guy, but I do love my spreadsheets.
Yeah. No, I want to give a shout out to our friend and listener, Ryan, here for evolving. I think that's great. One thing you're going to find, Ryan, and everybody else, this is going to evolve too, what you're trying to do, because you're going to figure out what are the things that you decided that you really want to do that turn out to be arbitrary and don't actually help your process. And you'll lose them and you'll find other things that do help you. So keep evolving and you'll keep getting better. I think it's great.
Yeah, no, I agree with that. This email resonated with me because I've gone through various versions of myself in terms of investing. And I certainly understand the not so much the skipping the steps due to FOMO, but the thing that hit me was like I spend the money the second it hits my account, because I've
Yeah.
often said to myself, let me let the cash grow for a couple months, especially right now where I do feel like I texted you the other day. I looked through all my investments, all my stocks, and I couldn't. There was nothing I felt super compelled to add to, and a lot of that was valuation based. And there was nothing on my watch list I wanted to buy, and that was mostly valuation based as well. So I said to myself, "Self, this seems like the perfect time to maybe skip a month and keep that cash as cash, so that when and if we have a downturn, you have a little more to buy it stocks at a better price." What did I do? I came back the next day and I bought a new stock. So
Right.
so I get it. I get it. But if the last thing I'll say about this one, look, if this podcast and our conversations and writing into us can help anyone, at least have someone to talk to about the process and the way that they're changing, then we've done our job here. So,
Yeah. No, I agree with that. Okay, next.
all right. This one comes from @AlienInvestor on Twitter. Question for Jason. I understand that most, if not all, of your invested wealth is in individual stocks. How did you achieve that when most 401k plans do not allow investing in individual stocks?
Well, there's a key word in your question.
Most.
Most, not all. Not all.
Right.
So first
But
of
talk
all,
about this, because this is something that I get frustrated with in my
yeah,
side of the world.
it's definitely very common to not be able to buy individual stocks in a 401k through your employer. I'm self-employed, right? So because of the fact that I'm self-employed, I have a solo 401k. I can buy whatever I want. Fidelity is the brokerage that I use, and in my experience, I haven't looked around, I haven't shopped around in a few years. But the last time that I looked, Fidelity still had the best solo 401ks. There's no fees. It works just like a regular brokerage accounts, only with the rules around a 401k, right? So that's great. I've also been fortunate for my wife that she has worked for large employers, and it's the industry that she works in. I think it's pretty typical that they have really good benefits in their retirement plans. And so she's had access to what's called a self-directed account. So you can pick individual stocks inside the 401k. So some are really restrictive. One company in the industry that I know of, that they're self-directed 401k, you can only buy mutual funds, right? You can't buy ETFs. You can't buy individual stocks. You can only buy mutual funds.
So
So
you can choose which expensive fund you invest in.
right, exactly. So, and there's reasons they do it, right? Because the reality is when it comes to individual investing, humans are the problem, right? Where our own nature gets in the way. And mutual funds, you have to buy larger dollar amounts. You can't just buy individual shares like you can with an ETF. You have to hold them for longer periods of time. You can't day trade them. The prices are set at the end of each market day and you're buying it from the fund directly. So mutual funds are more restrictive. But again, the point is just a lot of good luck. More evidence of good luck helping Mr. Jason do well. So
Yeah, I just want to pause on this and add, it's worth looking into and asking questions of whoever is in charge of benefits for wherever you work, to really find out what the options are that are available to you. Because I know, so I have a 403b. That's what educators have. My wife has a 401k. And if it wasn't for me logging into her benefit stuff, or her logging in for me and me clicking around, like, I wouldn't have known what the options were available. I don't believe that she has the self-directed option, although it could be something that I just have missed. But regardless, she has no interest in buying individual stocks in her 401k anyway, so it's a moot
right.
point. But just, and this is a very niche example, but by virtue of me asking a lot of questions to a lot of people several years ago, I was able to find a self-directed thing that I could invest in my 403b that apparently is only offered to people in New Jersey with this one company. And all of the other options I have are not great. They're like super high fee vendors in bad 401ks. So I found like the purple unicorn in the sea of bad investing options. And I wouldn't have done that had I not just asked a lot of questions, right? So I think that
Yeah.
that's the takeaway for me is ask, find out, make sure you're not missing anything, talk to a benefits manager. And if there are no great options and you want to buy stocks, max out your IRA and buy some stuff in a brokerage. Like those are ways to still get that exposure, even if you're dollar cost averaging into a mutual fund in a 401k.
I want to add one thing, the last thing I want to say about this. I think it's really important. We've talked about it before, but definitely talk to the benefits people at your company, especially if you work for a small or medium-sized business. They probably don't really have experts. Usually it's like the HR people who generally don't know finance and investing, right? But they handle benefits and that kind of stuff, so it gets thrown on top of them. And there's a lot of small and medium-sized businesses that need employees that have specialized knowledge in this sort of thing to be involved and to help the company do better by their employees. So it may be an opportunity for you to leverage those skills in a way that benefits the company that you work for in a way that you didn't even think about. And also you get something better. You get a better 401k as a result. And also so many people, like, especially if you talk to a financial advisor that it's commission based and they're not a fiduciary. I've heard financial advisors tell people to not put money in 401ks because the advisor, they just want you to give them the money.
Right.
And you walk away from the tax benefits, you walk away from the employer match, like real dollar amounts of benefit that even in crappy funds generally mean better total returns, right?
Yeah.
So be really mindful about making that mistake and thinking you're the next Peter Lynch and you can just outperform by buying stocks yourself. You probably can't. Don't miss the free money.
Yeah. Yeah. And our former guest and colleague at the Motley Fool, Robert Brokamp, who's an expert in retirement, all things retirement, says that a lot. I've heard him say that a lot, that you should just go talk to your benefit people and say, hey, we should have better options. And a lot of times you can affect that change. So
right.
Good to remember. All right. Our next question comes from Adventures with Rubes on Instagram.
By the way, we learned, thank you for clarifying this. Ruby is Adventures with Rubes' dog.
Yes.
So
because we did question this username a couple of months ago on the mailbag.
Yeah.
It's also fun to see we're getting a decent amount of questions from our Instagram account. So if you guys are on Instagram and you want to follow us there, do that.
Yeah, we're on all the socials too. If you mess around on TikTok, we put stuff there too. So
maybe we'll pop up in your TikTok algorithm one day. All right. Adventures with Rubes asks, how do you value a company that is not yet profitable? There are a lot of high growth companies that are not yet profitable, especially in the tech industry. Just curious how you go about investing in these companies.
So I'm going to say this just to trigger our friend Tyler.
Price to sales?
Yeah. Yeah. No, not on its own, but price to sales can be directionally useful when you're comparing a company to maybe its profitable peers. It can give you some idea from that, like just a quick and dirty starting point. I think it can be useful. But typically what I do is use cash flows, cash from operations as a starting point, free cash flow as well. And look at the trends, Jeff, because what you should see is growth rates of those cash flow metrics improving, even if they're burning cash. Generally, they're going to get to positive cash flow before they get to GAAP profitability. And free cash flow will catch up with operating cash flow and move positive. So it's a good thing to follow. Again, looking for the trends, looking at the growth rates. You can look at the multiples. Like you see a stock that trades for 70 or 80 times free cash flow. And it's like, wow, that's crazy expensive. It is. But if they're growing free cash flow 30% a year, and there's a realistic possibility they can grow at, a 20 to 30% rate for the next 4 or 5 years, plus before that rate starts to drop into the 20s or teens, it's actually probably not crazy expensive because it's growing it so fast. So those are usually the metrics that I'm looking at.
Yeah. When I look at companies that are not profitable and sometimes even not yet cash flow positive, right? Because then it becomes harder to look at, price to free cash flow or something like that. To me, then it's about two things. And one that I actually do a lot and one that I want to hear your thoughts on. So one that I do, it's looking for those trends. So if I'm looking back over the past, let's say 2-3 years, and I'm seeing those losses getting smaller and smaller, and in both cash flow and or profit, just, bottom line profitability, net income, that's kind of what I look at more than valuation. Like, I don't want to say I ignore valuation, but I think I worry less about it if, and that's where like the relative
Yeah,
comparisons for like price to sales can help. So like I'll just a quick example, like
exactly.
if you're trending in the right direction, but you're trading for 70 times sales, that means that the market's pricing in eventual
Massive amount of
profitability
growth.
and a lot of growth. And if
Yeah.
the other not profitable companies that you want to compare them to are way less than that, then you could say, okay, so this is probably on the higher end. Now they might grow into that valuation and be fine, but those are it's not an art, it's a science. Sorry, it's an art, not a science at that
Yeah.
point.
Yeah.
The other thing that I think, I wonder if I've never really used this, but I was thinking about it recently. I typically ignore analyst estimates because they have different incentives for those are short-term targets in is my understanding. They have to
Yeah.
come up with a price that's going to be within a year because that's what their job is, right? But I do wonder for some of these companies that are at the early stages and high growth, if it is worth just seeing what the analysts think that company's going to do in the next year or so, because that could give you an indication of how much the price is based on hype versus maybe something that actually could come true. I don't know. What do you
Yeah.
think about that?
Yeah. I mean, generally, if I'm looking at anything from an analyst, I'm looking at their words more than their numbers most of the time. What are they saying? What are the catalysts? What are the headwinds? That
Like,
sort of
why
thing.
is the price target X
Yeah, no,
dollars in 12
exactly.
months?
Because
Yeah.
here's the thing, they don't know where the price is going to go any more than the rest of us do. And broadly, analysts, you could flip a coin and get this similar accuracy to those analyst estimates and the guidance that they put out. But what they do know is the industries that these companies operate in. And it's a great way for you to become a little more knowledgeable about the spaces that the companies that you're interested in operate in and the competitors and the competitive landscape and all of those things. So I think that's where analyst notes and things like that can be really useful.
Yeah. Okay. That makes sense.
Hey, everybody, we'll be right back, but first, a word from our sponsors.
FinChat.io is the complete stock research platform for fundamental investors. They have all the standard financial data on more than 100,000 stocks globally. But beyond that, they have company specific segment and KPI data on around 1,800 stocks. So, for example, do you want to see NVIDIA's data center revenue growth? They've got it. Do you like to track Apple's iPhone sales? They've got that too. Or how about nights and experiences booked for Airbnb? You guessed it, they've got it. And they just added around 8,000 ETFs and mutual funds to the platform. The breadth of FinChat's data is truly one of a kind. I use FinChat every single day as I'm researching the stocks in my portfolio, specifically when I want to see how they're doing on KPIs that FinChat is famous for. So to get 15% off any paid plan, go to finchat.io/unscripted. That's finchat.io/unscripted to get 15% off any paid plan today. The link will be in the show notes. Hey, Investing Unscripted listeners, this episode is brought to you by our friends at Yellow Brick Investing. Yellow Brick is an aggregator of the best stock pitches across the internet. By tracking thousands of blogs, newsletters, fund letters, podcasts, and more, they're able to collect and summarize the best stock pitches from all over and bring them to you in one single place. Think of it like a modern value investors club. I have to say, this is pretty cool. I can just type in the company I'm interested in and get a bunch of different stock pitches from across the internet. It helps me think through new ideas and find opposing points of view on the stocks I'm interested in. And the best part is, access to Yellowbrick is completely free. Try it for yourself. Simply go to joinyellowbrick.com and search a company or ticker you're interested in. You're bound to find a great report on just about any company. That's joinyellowbrick.com. All right, let's move on here. We had a question from Simon via email. Two questions, actually. First, how much do ethical considerations like environmental, human rights, etc., play a role in your stock buying decisions? And secondly, do you ever listen to your gut more than your head when making a decision? I know I should have done so on a couple occasions. Couple of occasions. I think each of these could actually be its own episode, Jason. We could go
Yeah.
on and on with these, but let's
Yeah.
take them one at a time. In your investing, where do you fall on the ethical considerations spectrum?
I don't want to say it doesn't matter because it does, but just my personal experience, I won't buy tobacco companies because I've lost a lot of family members from the impacts of that industry. That's just about the only industry that I have circled that I say I won't buy for ethical reasons. I own companies I've owned shares of Transocean, right? One of the companies that was in the middle of one of the worst offshore oil disasters in history.
Why do you hate the ocean, Jason?
Yeah, I don't hate the ocean as much as I love money. No, I know that sounds terrible, but no, I'm kidding. Everybody listen to this, you should know I'm just kidding around. But I think about of economic necessity with businesses. I don't want to crib our friend Jim Gillies too much here, who's talked about you're not buying stock from these companies. You know, you're not giving your money to the companies. You're buying stock from another investor, right? Use your investments to make the world as you want to see with the money that you then put back into the world, right? He talks about that, and I kind of buy into that a little bit. So not much, not much. I don't really want to say much more about this because I'm probably just going to piss some people off.
So I've sort of evolved on this. When I was brand new and just learning about all this, I was very much like, I'm only going to buy companies that I believe in and do a good thing. And I've largely stuck with that. But what you learn over time is no company does everything you want them to do,
Yeah,
and you'll find a company that you think does good in the world, and you'll find out their CEO donates to the political party you don't agree with, or, whatever that is,
yeah,
right? So you'll always find
exactly,
some
exactly.
reason, or they made one decision here that you question, or, so there's no perfect company. So I had to let go some of that just in order to be an investor in anything.
Yeah,
I I actually kind of do like that way of thinking, which is make money any way that you can and then use that money to make the world better, because you could think of
yeah,
that in any different way. Like I could
right.
have $10 million sitting in an account when I'm 90, and I could decide to donate that to a charity I really care about. Or it could just be the financial freedom I get from my investment allowing me to retire early. Then I'm able to volunteer at the hospital, right? Or
Well,
whatever the
and
thing is I want to go do.
you're opening up a good professional career path for a younger person that'll be replacing you. So retiring early makes the world a little better too. Stimulating the
Yeah, I never
economy there,
thought of
buddy.
that. I'm gonna retire right now.
There you go. There you go.
I'm doing
So
it
no,
for
I
the
love
youth.
here's so I do love David Gardner's quote, invest in the future you want
Make your
to be.
portfolio reflect the future you want. Yeah.
Right. And I love that. But I think there's a little bit of this just I think part of the beauty of that is just if you invest in the future, you're investing in disruptors and innovators, right? Which can be a pretty great way to be successful. But here's like this sentence, I think sums it up for me. Investing is already really damn hard. If you start applying arbitrary rules that further limit the pool of investments, you're making it even harder to succeed.
Yeah. Well, so here's where I landed with it ultimately. Like nothing's on my never list really,
Yeah.
but I just, now that I'm at a point where I pass on more things than I don't pass on in terms of just how my process has evolved. And if you want to hear more about how my process has evolved, we just did an episode on that a week or
Yeah.
two ago.
Yeah.
But I find myself, because I'm passing on most things, I just pass on the things that I don't want to root for. So for me, it's not so much
Yeah.
an ethical thing anymore. It's just I want to be able to root for the companies in my portfolio. I want to be happy
Right.
when they do well. And if I owned, I don't know, let's just use tobacco as an example. If I owned a tobacco company and I'm listening to an earnings call and they're like, revenues are up 30% because more people bought cigarettes. I
Right.
guess it's great because I'm going
Right.
to make more money, but it's kind of a bummer. I don't really want more people smoking. So that's where I landed. It's less of an ethical thing and just more, I
Yeah.
want to be able to root for the company in some way. And I don't want to root for the things I don't believe in. And I don't like smokers. So
Ethics often come in when I'm really looking at a company. Because it's part of how I'm wired, right? It's part of how you're wired, but it's definitely not like part of my primary framework.
yeah. Yeah. All right. So this is almost a good segue into the second part of his question. Where do
Yeah.
you fall on the spectrum of using your gut or not using your gut when you're making a decision?
I can't remember which episode we talked about this on, but one of the things that I've come to learn, and I've used this is another turn of phrase that I've used before. People don't rise to the occasion; they fall to the level of their training. And I think it's the same way with investing. And what I've found is that when you're inexperienced at something like this, your gut is just your biases firing, right? You just the way that you're wired to react to stimulus
Mm-hmm.
that's telling you what to do, not years of experience and knowledge about a thing and acting based on seeing a clear opportunity to move. For example, I'll go back to the bank crash that we had last year, I guess it was.
Yeah. Last March.
Yeah, because I followed the banking industry for as long as I have. I mean, I cut my teeth as an investor coming out of the financial crisis, right? So I've spent years and years studying banks and bank crises and what they look like and seeing opportunities. It was the most clear time since the financial crisis that I can remember seeing what was going on in the banking industry and saying there is massive opportunity to aggressively buy high quality banks right now. Right now. Bank stocks were crashing because there were a lot of investors who were going the other way because they saw risk when there was really opportunity. So you have to be really careful about reacting to your gut because you know what guts are full of.
Go ahead, say it.
Poop. They're full of poop.
I like that framing of the degree to which you trust your gut should be correlated to your experience level.
Yeah.
And because I think you're right. When I think about the things I made gut decisions on when I was new, it was based on nothing. It was just based on vibes. And now if I feel like I have a gut decision on something, I'd like to think it's based on some experience and pattern recognition. I think a good way to think of it is this. If you're listening to this and you've been in your line of work, whatever that is, for let's just say a decade or more, there are probably decisions you make every single day that are gut decisions. Whether you're in construction or education or in science, you see things and your brain's going, I've seen this 100 times before, it's X, or I've seen this 1,000 times before, it's Y. And you just don't have that perspective the first day you're at a job.
Right.
And I think that's the connection I'm making to what you're saying. I see things in the world of education now and I just recognize them immediately because I've been doing it for 24 years and I wasn't able to do that when I was 21. So I'll say the last thing I'll say about this one, then we'll move on. For me, where I am right now, I tend to trust my gut when it's a don't do it decision. And I tend to question my gut when it's a do it decision.
Yeah.
Because I feel like as I become a little pickier and skewed towards the you don't have to swing at every pitch way of investing, if I get the ick or I'm just not sure, it's just easier for me to just pass and go back to something I have high conviction in or go turn over another rock. And if I get something where I'm very, very excited, that might drive me to make a starter position or something where it's a low stakes way of learning. But if I'm very excited, like if I ever feel like I should put 5% of my portfolio in this one thing, I will stop myself and not do that. Because I feel like that's where I don't trust my gut yet. And I'll probably feel differently about it 5 years from now and then 10 years from now and so on. So
I don't know if you will, because I think that's really smart because it reminds me of the idea of forced errors versus unforced errors, right? And the difference between professional tennis players and really highly skilled amateur players is almost never their physical abilities. It's their ability to avoid those unforced errors. And I think that's a transition that you've made where the error of commission, your gut's telling you to do something and you're like, I'm just going to not do it. And you know what? Not doing it might be a mistake in terms of a missed opportunity, but you also didn't make the mistake that could cost you money. And you also, again, there's not doing it yet.
Yeah. I mean, I'd much rather the classic example I'm thinking of is when we did the portfolio contest 2 years ago and I picked Meta because my gut was telling me they were going to really head in the wrong direction because of all the spending on the metaverse. And I think the stock's up 300% since then. So that was an instance of my gut being wrong, but I'd rather make that mistake and then buying, whatever, $10,000 worth of a stock that goes to zero. So.
Right. Well, I mean, the corollary there actually is the unportfolio was essentially shorting, right? Was what we were doing. Because if it went down, technically it was going up based on what we were trying to do with the contest. So technically you shorted a stock that went up 4x.
Yeah. Well,
ouch.
On paper, I paper shorted Meta at the exact wrong time.
Yep.
All right. This next question comes from a Canadian listener, a little bit of a long one, so I'll try to get through it quick. We are going through the age-old question in my house right now: invest or pay off the house more quickly? Let me give you the details. In Canada, we have something called a tax-free savings account. We can own investments in it, no taxes when it's pulled out. The current max contribution is $95,000. It grows every year. Next year, you can add another $7,000. I can take it out at any time. And if you own Canadian companies, there's no withholding taxes on dividends, and I love dividends. Our accounts just grew past what we owe on our house. We have 2 years left till we have to renegotiate our mortgage. In Canada, it's a 5-year contract, not a 30-year fixed loan like the land of the free. And our interest rate is 2.09%. Our TFSA generates $7,800 a year in dividends. Our mortgage costs us $3,000 a year in interest. The math says invest and just pay down the house as fast as you can. What I'm thinking, grow and invest for 2 more years when the mortgage is due so we don't liquidate the entire thing and pay down the house. And for context, I'm 35 and my wife is 37. So Jason, long email, a lot of details about Canada, but the basic question is, does the math make sense for them in their particular situation to pay off the mortgage, keep investing? How do you see this?
So this particular listener, we exchanged a little bit of back and forth to get a little more context and some more insights here, but I do want to be a little more general here on the show. Number one, this is always a kind of squishy one when it comes around pay off the house or not pay off the house.
It's a personal decision.
It is.
And really often it's down to.
And often it comes down to like the sleep better at night sort of arguments. And the way I think about it is a couple ways. Number one, I think, what makes me sleep really well at night is having a pretty sizable nest egg, investments in cash. That means that I would be able to afford to pay my mortgage and other expenses in the case of a catastrophic event where lost employment, long-term illness, severe accident, the sorts of things where you need to have money. I think the money can be more valuable than having a paid off house. I also want to point out that using debt for a mortgage is one of the smartest ways to use debt. You're using debt to buy an appreciating asset. You can have as long as you're alive, right? So I think that's an important thing to remember. Obviously, in this case, they still have a couple of years at a 2% rate. There is no reason in the world besides I want to pay off my mortgage that it would be the smart thing to do to pay off the mortgage in the next couple of years. But Jeff, 2 years is short term when you're talking about stocks. So if you're thinking your mortgage rate's going to go up to 5, 6, 7% in 2 years, and maybe in 2 years you do want to pay it off, time to start rolling some of that's equities, those stocks, into CDs or cash savings or bond ETFs. There I go, bringing up that again. But I know, wake up, Jeff. Sorry, I didn't mean to.
Sorry, what were we saying?
But no, the point is, it's 2 years, and all it takes is one bad downturn, and that $95,000 is $70,000.
Yeah, it's a personal decision. I mean, the famous person who has talked about this, and we've probably mentioned it on the podcast, is best-selling author Morgan Housel, who used to work for the Motley Fool, and now he's just writes books and makes, sells millions of copies. He has said, even though he absolutely acknowledges that it was not the right financial decision, him and his wife decided to pay off their mortgage, years ago.
Yeah.
And because for them, that was the right move. The flexibility it gave them to not feel like they were locked into a certain place and all that kind of stuff. And that's someone who really understands money. So
would it be in bad taste for me to point out that Morgan Housel is also very wealthy?
Fair.
No, but it matters. I think
it does matter. But
the
way I was going to go with that next, though, is like, so for me, for example, I'm not quite as wealthy as Morgan Housel. And
hey, you're one number one bestseller and a follow-up bestseller.
Between Morgan Housel and I, we've written 2 best-selling books. I hope we have him on the podcast one day, and then I can make that joke to him. So I hate debt just personally. Like I would not be comfortable if I had multiple types of debt in my life. But for some reason, I know it is debt. I'm not an idiot. I don't ever think of mortgage debt as debt. It's like, to me, in my brain, and I'm not saying this is the correct thing. I've also led a very privileged life. I just think of my mortgage payment as I have to pay to live,
Right.
And it's, I was smart in my buying of the house, and it's not an amount of money that is an oversized burden on our finances and that kind of a thing. So for me, I think even if I had a higher interest rate, I mean, I locked in during the low times, so I'm okay. I don't know that I'd be in a rush to pay it off
Yeah.
unless I was really feeling like it was bothering me, or I don't know. So again, my point is it is personal. Everyone has to kind of make that decision for
I
themselves.
I want to offer an exercise that maybe people can do that are going through the same thought process to decide what makes sense for them. And this is what I've done to kind of work through going through some of this same thing. I don't have pay off the money mortgage just set aside in investments. But one of the things that we did when we bought our house 3 years ago now is we made a smaller down payment from the proceeds of the house that we sold in California. So we kept some of the proceeds from that sale actively to invest in stocks, largely dividend stocks, dividend growth stocks, simply because the thought that that's going to outpace, we're going to be able to grow that money faster than it would reduce our interest expense, like the compounding power of that. So I think a good exercise is just to kind of sit down and make a list of that in this case, just under $100,000 that this listener has, however much money you have, make a list of things that you would do with that money down the road in the future, right? What would you do with it? What could you do with it? What would you love to be able to do with it? And then think about what could it be worth just over 5, 10, 20 years of appreciating it, say 8%. So let's say we have a weak period, the market doesn't do as well as it has historically. Set some like low threshold, 5%, whatever, and do the math and figure out how big that number would be. How much money would you have then? And think about the value of that money or that future wealth in making your life better versus paying off your mortgage now, starting back at zero and trying to reaccumulate every month, or instead of making the mortgage payment, you're putting that money into, in your investing account. So dream a little bit about, how that money, you could use that money in your life, that future wealth in your life. And sometimes I think that can actually help people deal with like kind of that little bit of fear of having the mortgage and start dreaming a little bit and thinking about, the power of compounding and creating wealth that can make your life better.
Yeah. Smart. Hey, everybody. We'll be right back. But first, a word from our sponsors. Heads up, folks. Interest rates are falling, but you can still lock in a 6% or higher yield with a diversified portfolio of high yield and investment grade corporate bonds on public.com. You might want to act fast because your yield isn't locked in until the time of purchase. Lock in a 6% or higher yield with a bond account only at public.com/investing unscripted. Brought to you by Public Investing, member FINRA and SIPC. As of 9/26/24, the average annualized yield to worst across the bond account is greater than 6%. Yield to worst is not guaranteed, not an investment recommendation. All investing involves risk. Visit public.com/disclosures/bond-account for more info.
Hey, Investing Unscripted listeners. My name is Brett, one of the hosts of the Chit Chat Stocks podcast. If you love Investing Unscripted, we think you will love listening to Chit Chat Stocks. On our show, we research individual stocks, interview investing experts, and, well, chit chat about investing every single week. From hot stocks such as Nvidia and Celsius to hidden small cap gems, we have something for every type of investor. Follow the Chit Chat Stocks podcast on YouTube, Spotify, or Apple Podcasts and start discovering new investments today.
All right. Next question comes from Colin. Bond prices crashed hard when stocks sold off in 2022. Are they still risky? Answer this one quickly because it is about bonds and we don't want to lose our audience.
Yeah, fair enough. Number one, yes, bonds are risky, but it's an investment. Every investment comes with some level of risk. With bonds, if they're treasuries, obviously they're very, very, very safe. Corporate bonds, companies go out of business and file for bankruptcy and struggle all the time. And, sometimes bond owners get a haircut, don't get all their money back. That happens. What happened in 2022 was really unique. Interest rates skyrocketed. And when that happened, the value of existing bonds got crushed, because why would I buy a bond from 2019 or 2020 that's paying a 3% yield when I could buy a bond that was issued in 2022 that's paying a 6% yield, right? So to sell those bonds on the secondary market, they had to be discounted sharply. So that's why bonds got crushed, because interest rates skyrocketed. We're in an interest rate holding steady and declining environment, which is bullish for bond prices. Because again, you've got that bond that's paying 4%. If interest rates get lowered, new bonds are going to pay a lower interest rate, right? So you can sell your existing bond for a premium to its face value to match the current yield of bonds that would be maturing at a similar period. So now I think is a much safer period to be owning bonds because of the direction that interest rates are going to go. It's one of the reasons I reached the decision to start buying bonds now, specifically bond funds where the risk lives for retail investors. Because if you bought a bond and you held a bond and you still hold the bond, you didn't lose money when the bond market crashed. You're still going to get your full value.
Right.
You're just getting a lower yield. What's that?
It's not getting repriced.
Exactly. It only gets repriced when you sell the bond, right? So if you've held it, you're just still getting a lower yield on those older bonds.
All right. Not too bad. I mostly stayed awake. Would you say it's fair to say that the way bond funds got crushed over the past several years was not likely to be repeated? I mean, anything's possible, but it was sort of a perfect storm of bad things that led to that. I mean, inflation went up and the pandemic and all that stuff.
Yeah, no, it was definitely a very unique circumstance. You could say it was a black swan event. Yeah, right. I think that's fair.
Next question comes from Cunning Project on Instagram. You are doing some solid work on your podcast. Thank you, Cunning Project. Appreciate the
You're
compliment.
doing some solid work as a listener.
Yes. But Cunning Project asks, with Boeing in turmoil, who benefits the most? Airbus, FTAI, HEICO? What do you think?
So definitely the HEICOs and the companies out there that are doing maintenance, doing service, like the third-party companies, the third-party parts companies, they're doing well because there's a lot of Boeing.
The fleet's going to stay older for longer.
Yeah, right. So it's definitely good for them. I don't think it really benefits Airbus because one thing we know about Boeing and Airbus both is they have massive backlogs. They're not just throwing out, buy on Tuesday. They don't have happy hour pricing when volume is down. Their lines are full. Their order books are full, right? You order a plane now, it's going to be years before you can get it. So I don't even think Airbus really benefits right now because they don't have spare capacity to take advantage of it.
I think in the long run, I wouldn't be surprised if we look back on this, if someone writes a book on airlines 30 years from now and Airbus is in a better financial position or a better market share position in 30 years than it is now, I wouldn't be surprised if you could track that back to this Boeing period as the reason why. But in the short term, if you're just looking for where to invest some money to take advantage of this, I agree with you. I don't think it's going to be.
Yeah. I'm gonna throw another name out there. I haven't looked at the stock, and I'm sure the market's already figured this out, and the valuation probably reflects it. But AerCap's another one because they own most of the planes. You see a big announcement from an airline that's agreed to buy a bunch of planes. There's a good chance that AerCap or one of a few other companies actually is buying them, and then they're leasing it to the airline. So they own all the used stuff, right? So when the leases come up, they're going to be able to re-release it. Their market's going to be a little bit bigger until Boeing can get their house in order and actually start manufacturing planes at any sort of capacity that's more than zero.
Yeah, we don't have to go down this road, but I do wonder if they have some sort of government bailout coming their way.
It's not going to be a bailout. If anything, it's going to be government taking over. I mean, they're such a mess. They're not going to bail anybody out.
Well, yeah, maybe. It just feels like one of those companies that's important enough to the country in terms of we need.
Oh, they're going to keep operating, but they don't need free money from the government to keep operating.
To be fair, to be clear, I'm not advocating for that. I just wonder if that's where this ends up, if they can't get their act together sooner rather than later. But different podcast for a different day.
Yeah. So next, we got a couple questions. I think we still got one or two, a couple more that we're going to answer, but I just want to acknowledge some that we got. ELCMSF on Instagram asked us a good question about financial education in public schools. If this is such a big question, we're going to sit on it. I think this could be something that might be good for a show down the road. We've talked about it before, no promises, but it's a big question. We also got one from Firm Returns on Twitter. Just got a DM just in the past few days, I think. This one was in reference to the show that we did talking about how much time you should spend researching a company. We actually had a couple of listeners give us their thoughts on this. And the thing that was really interesting about this one to me is how their process has changed and how they take typically more time and also kind of sit on an investment or sit on an idea too. So I think that's really, really valuable. And the thing that stood out the most, and I love this, they talked about how half the time they spend is researching the industry, not necessarily the specific company. I don't think most investors do anywhere near enough time studying industries. They just cherry pick companies, or they hear about a company and they study that company and they don't really know the industry that it operates in really well. And that's a big disadvantage. It's like trying to go up against a really good pitcher and you've only studied fastballs.
Yeah.
And this pitcher has a really good curveball and you
Yeah.
don't know what curveballs look like. You need to know the industries.
So I'm guilty of that. I don't do nearly as much research on industries of companies I'm interested in. But I think tied to that too is sometimes in doing that, you find out that a competitor to the stock you're looking at is actually the better investment.
Yeah.
So
No, that's exactly right.
So we did get one from Lance on Twitter that I think we should answer today because I thought this was a good one. So Lance says, Howard Marks says that for a portfolio to be successful, a level of risk should be both targeted toward a goal and well compensated. The best relationship between return and risk, but with targeted outcome. My risk capacity is higher than the risk I take, but I pick the best stocks I know of. My method is to rely on almost all stocks making money over 10 years and keeping in mind that David Gardner would have done better if he never sold anything. I hold 120 stocks that have been recommended several times and mostly have had strong 10-year charts, and at least half of them issue dividends to guarantee returns. I try not to look back and buy the best ideas after I compare a list of them. That ideally seems to keep me from having to worry about selling, but I have traded up a couple times this year. What do you think about that?
Yeah, it's a process, right? And it's a process that Lance is comfortable with, has become familiar with, how it helps him, how somebody super successful like David Gardner has pointed out, even he has missed opportunity by doing things like selling, right? So I think it's great. I really do. The fact that there's a process and there's some frameworks, again, we've talked about it, that help Lance go through his process of thinking about the actions and the steps he's going to take. I think it's great. I really do.
I want to ask you a question, Jason, about a piece of that. The idea that someone like David Gardner has said, like, he would have made more money had he never sold anything. Do you think that's a lesson the average individual retail investor should actually take? Or do you think that's something that's unique to David Gardner, who's just a successful, good investor himself, but also has a team around him and, he works at a company that picks stocks. So he's got advantages that the average listener to this podcast doesn't have. But I guess what I'm saying is I worry that people hang on to obvious losers for way too long because they just say like, well, Gardner says never sell. What do you think about that?
Yeah, no, I think that's good. I think that context really matters. And I think particularly when thinking about David Gardner's examples, and I can back this up with my own experience, it's almost always selling winners too soon, not sitting on losers that then magically turn into winners.
That's a good distinction to make.
Yeah. And I think that's the most important thing to remember. And again, it's the famous quote, Peter Lynch has said a version of this, David has said a version of this, but it's essentially comes down to picking your flowers and watering your weeds, where you want to do the opposite. But I think you do have to do some of both. And for me, I think the really important distinction I want to make is sometimes selling a winner still makes sense when you have to invert. And at some point, I've talked about a lot in recent episodes, I'm getting to the point, 50's not far away. We've benefited from high income, the tailwinds of a really strong market for the better part of 15 years, where we are a lot closer to our financial goals than we wanted to. I have to start looking at the downside too, and not just the upside. Sometimes taking some upside off the table, reducing exposure to a big winner and increasing exposure to higher floor stuff like fixed income investments, high quality dividend stocks, and not just the best growth ideas because of the downside risks that can sometimes come along with that, is still the right move, because it's not always just about growing your wealth. Sometimes it's just about preserving some of it too.
Yeah. Good points. All right, let's do one more that I think you can answer quickly, and then I have the spam comment or question of the month for you. So this one, our last real question, comes from PHX Mafia 13 on Twitter, who says, "Hi, I wanted to reach out to you regarding SolarEdge. The stock has absolutely cratered this year and is trading at $850 million valuation." I'm assuming he means market cap. Is this still a buy?
Yeah, I don't think SolarEdge is a buy right now. Stay tuned. We're going to do some videos on our YouTube channel, taking a look at it. ENPH just reported, that's its sister company in the kind of duopoly for the panel level electronics, the microinverters and inverters and that kind of thing. And ENPH is kind of threaded the needle with still being cash flow positive as they've kind of brought their operations down as demand in residential has just collapsed. There was a little bit of a turn in the quarter they just reported, but it looks like it was just seasonality for the quarter or for the summer, because their fourth quarter guidance is for units to fall again. Units were down like 75% last year's fourth quarter. And they're saying this year's fourth quarter is going to be below even that. So the cycle hasn't turned. SolarEdge just has not managed their operations and their manufacturing capacity anything near as well as ENPH has. They're burning cash. They're losing money on a GAAP basis. I'm not touching SolarEdge until they show that they can get their discipline a little bit better to meet the size of demand, because they're going to have a lot harder way to go if they don't kind of get things clear. So I want to see some signs of better discipline from their operations before I would buy SolarEdge.
Can I ask you a larger question about the industry that we don't have to spend a lot of time on, but something I've been thinking about? Because I've had Enphase on my watch list for a while. It seems to me that one of the things holding me back, I think, from investing in either of those companies is getting solar panels still feels like a small amount of people, niche, mostly wealthy thing that people are going to do because it's just so expensive. I mean, even if you get a really low interest rate and finance it, it can be the price of a car,
Or more. Yeah.
So is there any chance or theories or predictions that down the road it becomes substantially cheaper to put solar panels on your roof to the point where, the average Joe can do it? And if not, what's the 20, 30, 40-year growth story for this industry?
To try to give a short version of a somewhat long and complex answer, yeah, a solar system for a house might cost $30,000 or $40,000. But what we're talking about really is offsetting the entire energy demands of an entire house for 25 years, right? So if you contextualize what it really is, it's not crazy expensive. And it's almost always cheaper than just continuing to pay the utility grid for electricity in almost every case.
So then I wonder, is it a marketing issue then? Is there a better way to introduce it to people? I'm even wondering if the power companies should start to say things like, "We'll put this on your roof for free." And then I don't know. So we don't have to get into it. That's the thing that holds me back. Maybe we can do a whole episode on this solar panel industry, but I don't know. I don't know that I trust the long-term growth, like the TAM, I guess, is the way I'm thinking of it.
Yeah, no, I mean, it's still a massive market. And I mean, but the bigger question really because residential has different puts and takes than the utility scale.
Yeah.
The utility scale is still like 60 or 70% bigger than that. I think bigger than that now, because we haven't seen anything like as big of a pullback in utility scale as we have in residential.
Yeah, I mean, I know the money makes sense in the long run, because that's why you see every school in my area has solar panels on the roof, but they're getting massive. My understanding is there's massive incentives available to do that.
I mean, they're not substantially different than the residential stuff. What's different?
Right. But a company or a business or a school district has the money to put out up front to do.
Well, it's cheaper. What it really comes down to, Jeff, is it's cheaper to put solar panels on top of a commercial building, and I'm going to include schools in that, than it is to put them on a house.
Yeah.
Because of scale, right? If you're putting 5 times the number of panels up, your installation costs are just cheaper because you're doing more. So on a cost per watt basis, that's where you start saving money. And the utility scale, it's an order of magnitude cheaper for them, not the panels, but the installation costs and the wiring and all of those sorts of things. That's where the real marginal savings happen for commercial and utility, where you still see more of that kind of stuff happening because it's cheaper.
Yeah, that makes sense. Okay.
But yeah, more later. We'll definitely do something more about that.
All right. Now, we didn't get any spam questions, so I had to find a spam comment. Now, this one actually was in Korean, came to us on Twitter in a DM, and I had to stick it into the Google machine and translate it. So the comment, Jason, when you translate it from Korean into English is, contact me, I will give you a surprise gift. And you don't have to answer, you don't have to respond. I just want you to know that this offer exists.
It's good. It's good.
And we can reach out. And with that, we should wrap up the show.
I will comment. I love gifts, but I don't really like surprises. So
yeah, no, I'm the same way. Yeah. I want to know what the gift is.
Yeah, I'm sorry, random spammy Korean Twitter bot. Love you, but I don't like you. That's it, right? We're done?
That's it. Well, we did get more questions, as we said earlier. We will answer them on the next mailbag and keep them coming. We'd rather have too many than too little.
Lots by email too. Joe via email, Andrew via email, Alex via email. Thank you for your questions. Yes, we have them. They will be on our outline for our November mailbag. So thank you for those questions. Be patient. This is a long-term game. You can wait another month, but we will definitely answer your questions. Thank you so much for that. Okay, Jeff, as we say on every show, not just the mailbags, these are our answers. They're great answers, except when they're not. Sometimes they're terrible answers. Either way, they're our answers. You can try them on, see how they fit, but you do need to find your own answers. You can do it. I believe in you. So does Jeff. All right, Jeff, we'll see you next time.
See you next time.